Hi everybody, welcome to the Finance This Property That podcast. My name is Dion Fernandez and I am a mortgage planner and finance professional. My goal is to empower financial legacies for generations, and I look to do this by using my over 13 years experience in finance and having special guest speakers like financial planners, accountants, buyer's agents, family lawyers who are experts in their field to provide knowledge and free education. And without further ado, let's get into our episode today. Hey everybody, welcome to this episode of Finance This Property That. Returning guest, Chris McNulty, Director and Head Buyer's Agent of Lucid Property Investments.
Correct.
Yes, got that right. Today, we're going to talk about some of the pain points, or one of the key pain points that my ideal client faces when trying to build out a property portfolio or just trying to get an investment property. As you all know, my ideal client is you're a time poor industry professional, people like doctors, lawyers, you got your solicitors, accountants, etc. Also, if you're self-employed, you're looking to build your property portfolio or structure debt more effectively. You've got either one of those or all three of those problems, I help you with that. I also have a massive team like Chris that is here to help you achieve your goals. So today we're going to cover off on a few things. I'm going to talk about the key pain points in when you're trying to scale a property portfolio and how buyer's agents help or where they don't help. Yeah, there's going to be some controversy coming into this episode. But 3 pain points. You're unclear on what your long-term strategy is. 2, you're buying investments with poor equity position because you're not really clear on the strategy. And 3, because you're a time-poor industry professional, you lack the sort of negotiation experience that's required. And you fail to see sometimes maybe the underlying value in property. That is what Chris is great at. So probably the best person to speak around this, right? So I'm just pumping your tires up, mate. So
Thank you.
Cool. Hey, mate, look, so last time we had you on, I think it was like episode 18.
Yeah. It feels like about 9 months ago, something like that.
Oh, man, I don't think maybe we've been going for a year, but
yeah.
How's the surfing gone? Because that's, you've been doing more of it or less of it?
Less of it. I know, shock horror.
That's not good.
I know. I've had some injuries in my back, which has forced me to lay a little bit lower. But in the last few weeks, I've been back out a little bit more often, which has been nice.
Yeah, still up the sunny coast?
I am.
Yeah, good. Do you ever go down to the northern New South Wales to surf or anything like that?
Yeah, all the time.
Oh, good.
Yeah, absolutely.
Different scenery, right?
Yeah, different scenery. Yeah, more sharks.
Rips and sharks, 2 of the reasons why I don't like, and salty water, probably the 3 reasons I don't want to like going in the ocean, really.
You definitely shouldn't go to the ocean.
No, the ocean probably doesn't like me either. Probably the shark wouldn't eat me. But, mate, really, really appreciate your time. I know you are a busy man. You're helping a lot of clients, and you're probably helping quite a few clients that are that I also see as my ideal types of clients. So,
really, and we share a lot of clients as well.
Yeah. So we'll share some stories today about a few things that went right, maybe some that didn't go right, and really talk people through some of these pain points. So let's begin with the first pain point. I see this all the time. I want to buy an investment property and I want to build a property portfolio. Okay, cool. What's your strategy? And people say, I need it to be negatively geared or positively geared. What do you reckon the first thing I tell them is?
What are you going to buy?
Yeah.
What are you planning to buy?
Yeah. Well, that's one of the things. And then I also say, well, that's a strategy you have very minimal control over, because negative and positive gearing is really determined by the rate. And COVID, everyone was positively geared. You had no control over it.
Yeah. And I think as well, negative and positive gearing is not a property strategy.
No, it's not.
It's not an investment strategy. It's sort of...
It's a tax strategy.
Yeah, that's exactly right. Well put.
Yeah, I think it's more of a tax than a buying strategy. So let's just debunk this myth, right? So you're unclear on what your strategy is. And I look at people and going, well, this is a long-term strategy. If you're buying property to get a quick buck, I feel sometimes you're doing it. So you may be doing it the wrong way, but you give me your.
I think the days of making a quick buck in property, they're not over. It's become far more complicated to do that than the average person. We don't really see the local builder doing a 3 townhouse development and selling them and making a fortune. You can't really make money doing that anymore. There's so much understanding and education in the market that there's just no space for that.
I think also construction, that doesn't help with the cost of construction going up. Your margins are very slim.
Well, margins are slim, and I don't know if it's as much about construction as it is just about the fact that if everybody else knows that this is an opportunity and a way to do it, then more people are in there doing it. And you've got this rise of property courses, groups, all of that type of thing, which are great. They're really educating people and giving people some understanding of what to do, understanding how property actually works. But yeah, flip side of that is it's really squeezing margins.
Yeah, because everyone's doing it.
Everyone's doing it,
and by the time people are on doing it, you've probably missed the gravy train anyway, right?
Well, or the one who's bought it has missed something in their costings.
Which is usually the cost of developing the property is very slim. But look, being unclear on your strategy. So one of the things is, if you're not clear on your strategy, how do you even know that you need a buyer's agent?
Well, it's a good question. Property for me is what I notice with clients is there's this huge you don't know what you don't know thing. And I think, if you don't know what your strategy is, how do you know you need a buyer's agent? Like, I don't even know where to start with that, to be honest. I really don't. If you don't have a strategy, what are you doing? Just going out and buying a house that you think looks good? Like, I genuinely don't know.
Yeah, and it's the clients that I've seen some clients, I go, oh, okay, cool. So they've engaged a buyer's agent. Buyer's agent wants a pre-approval. The first thing Leah, what's the strategy here? Like, because you're asking me to run numbers, but I don't know the strategy behind your numbers. Because I'm trying to figure out debt structure and finance and I'm trying to plan your mortgage, which actually has to fit with your long-term, with your potential buying strategy and your property strategy. And so one of my clients ended up buying this property in the middle of nowhere. And I've just gone, that's completely not what we talked about. Because, it was within my price range and et cetera. I go, no, it wasn't. It was, yes. But could we have if we had a conversation, if we actually did a bit more research, could we have had a different conversation with someone different? Maybe get a better quality asset.
Yeah. Okay. Yeah.
Yes.
But that is the sort of thing that happens. People just turn up and they go, oh, I just saw this house and I liked it. And you go, okay. And I think that's fair enough if you are buying as an owner-occupier. But, we're here talking about property investment. And I don't think that is fair enough as a property investment of just going, oh, it seemed like a good house. And so I bought it. Doesn't seem like that smarter strategy.
Yeah. So, good house, fair price. Well, if it's a good house, fair price, do they really need you?
No. If they really are up to date and they understand this stuff, you do not need a buyer's agent. And yes, I run a buyer's agency, and I think if you are a investor and you're just out there buying a regular house, just trying to get a regular house return, and you think you know what you're doing, you're probably fine. I don't think that necessarily there's a buyer's agent for that. I think the job of the buyer's agent is to get you a far better property than what you'd be able to purchase on your own.
Yeah.
And that's what I do. That's the only real reason for my business existing. If I was just out buying regular houses that anyone else could buy themselves, I wouldn't be able to get out of bed in the morning. Because there'd be no reason.
Exactly. Because you're obviously paying a fee, and that's great, fee for service proposition. Sure. But you're paying for the advice. You're not paying. The fee is because of the advice, the research, the tailored approach to your long-term property plan.
Absolutely, Dion. That's and very few people speak about that, and that's really interesting. You've highlighted that because I actually say to clients quite often when they're signing up, I say that 70 to 80% of the fee that you're paying is for me to tell you which is the right property to buy. And 20 to 30% is actually the going out there and buying it thing. Like that's not a huge part of I don't think that's a huge part of the service. For me, it's all about being able to say which property is the right one and choosing it.
And that's pretty similar for my role. It's around I guide you and look at your requirements and objectives, look at all the research, all the policies, check all the valuations to come up with the debt structure strategy and eventually the lender that best fits your long-term lending property. So, I mean, whereas most of my clients won't pay a fee, there'll be some depending on the type of lending we're doing, whether it be development, there's stuff outside of normal standard residential.
Yeah, but your clients, they could easily just go to CBA by themselves and go and get a loan and probably get it done. But it would be almost certainly a much poorer outcome than if you were to get involved and to help them. And so, our businesses are identical in that way.
Exactly. It's just different. You're going buying property. I'm giving you a mortgage to go buy that property.
Absolutely. Yeah.
So, and I think that's where the role of the buyer's agent, especially the role of a mortgage broker, if you're working closely, and I find this is the best way to work. We actually were working on a client just recently together, and you're like, I got a contract. I'm like, hey mate, whoa, okay, let's just figure out whether they can do this or not.
Yeah.
And then when we looked at the numbers, it was like, oof, okay, actually, if we actually get this stuff sorted, you're actually probably going to get a better outcome. You're going to find a better property. You're going to be able to negotiate better. And the experience for that client would probably mean, hey, actually, cool. They've actually all got my best interest at heart. No one's actually trying to force me into a property, do this, get me into a loan that it's probably, because I said, I'll get you the loan, but if you want to do it this way, it's going to cost you this much. Is it really going to get you where you want to be, or will there be another property?
Absolutely. And you touched on a really interesting point there of like no one's forcing them to do it. Like I'll often tell clients, no, you got to pull out of this deal. Like we'll put something on. Actually, yesterday we pulled out of a deal because it all looked good on the surface, and then there was this really finicky thing that the town planner picked up that was going to have major implications for the long-term value of that property.
Yeah.
And so, it all looked good, but no, not with that. And so, I think that's huge, isn't it? Like,
because then you've just really then touched on the next pain point. Let's say they didn't get the advice. Like the person, I don't need a buyer's agent. I'm just going to go buy that property. So they've gone and bought that property. And then your biggest issue is trying to build a portfolio. You need a couple of things. Income. That's either got to go up, either by you earning more money or the rents go up. And two, you need equity.
Yeah.
So the next pain point is if you're buying a poor property that doesn't have equity, how does that actually help your strategy?
No, it doesn't. It doesn't. And I actually have this thing about like there's not really such thing as a good and bad property. Yeah, there is to a point, but overall, I'm not a huge believer in this property's good, that one's bad. But I am a very big believer in you can underpay and overpay for properties. And I think that's a really, really big point there because sure, when you go and buy a property, I think most people know that the bank will value it pretty much at your contract price.
Yeah.
So even if, like I remember I bought a personal property for myself last year and I paid $650 for it, and it was a part of a more complex deal with a few other houses in the mix, and I bought that one, and it was easily worth $850. Bank still came back at a $650 valuation, and so that's okay. But then in that, 12-month time when you want to come in and buying the next property, you want to be able to have equity so that that property is worth more. You can borrow against that to buy the next one. And if it's a poor purchase in the first instance, the chances are when you come to revalue it, it's not going to be worth really any more than what you paid for it, or not much more.
Yeah, exactly. And what are some of those key factors that play into that value? Do you feel like, if you're buying that wrong property, what are some of the mistakes that you've seen people make? Like
people not understanding how to value property. That's what I see as the biggest one, of going, oh, well, this one sold for this price, that sold for that, so therefore this one must be worth this. And I have found that I've actually been surprised of how difficult that is, because there's so many factors. And, I have a property economics degree. The guys that work for me are all either graduates of property economics or in the process of getting their degrees, which is where you learn to value property. It's the degree that all the property valuers would do. Property valuation is a lot harder than it looks. And we make a really concerted effort to make sure that we're valuing correctly, better than the market, so that we know how much an asset's worth.
Yeah. Because, let's not talk about off-market stuff, like the stuff that you see on realestate.com. Some of it doesn't even have a value on it. Okay, cool. Some of it has offers over X. And then some of it has from this number. So it's how do they get to that number? And just because it says that number, is it really worth that number, or is it worth more, or is it worth less?
Absolutely, and that's such a risk because there's no safeguards to tell you, oh, you're paying too much money for this property. There's plenty of safeguards to say you're paying too little. When you undervalue it, you won't get the properties. You just won't be able to buy them. But if your valuation is wrong in the other side and you've overvalued it and you think it's worth more than it is, that's no one's going to stop you. And that's actually something that I've been thinking about a lot lately. I was having a conversation on another podcast run by a guy who has a Validum Institute, which are excellent at real estate training. And we're talking about that, there should be more valuation training. Buyers agents need to learn how to value. Property investors need to learn how to value. And I think that's the core of a good property purchase, is understanding how to value property, and when you've bought it, knowing that you've paid under market value for it.
I'm gonna throw something else out there. If you're time poor and you're trying to buy a property, is learning how to value a property gonna benefit you, or is the opportunity cost of you just going and do your job, knowing that your buyer's agent is actually trained to get you trained how to value a property and trained to get you the best outcome? And if you're paying for that service, let's say you pay 15, 20 grand, and then they actually get you the deal that saves you 15 to 20 grand, that's worth it.
If that's great in theory,
yeah,
and if that's the case, if that can actually happen, that's great. But you said something really interesting there. You said use a buyer's agent that's trained to value properties, and my response to that is, well, are they? Like, who's trained? Who's training buyer's agents? Like my guys are trained because I train them. The university trains them. I was trained by the university how to value property, all of that, not to mention all the experience. But like if someone's coming into buyer's agency and, they were a personal trainer 18 months ago, or in media sales, or, something like that, they don't know how to value property. And so that's a big risk. So I don't know if using a buyer's agent is actually a guaranteed safeguard to overpaying.
Well, using the right buyer's agent.
Using the right buyer's agent, yes.
100%.
Yes. Use someone that knows how to value property, someone that's got a property economics degree or something like that. Yeah.
Yeah, but also I look at it as you go to a doctor. If it's a specialist, you want to know that they've got the specialty qualifications.
Absolutely.
But also, buyer's agents, and like some mortgage brokers, some of them never even bought a property in their life. but you're selling a property and you've never bought in your life.
Yeah.
I mean, I've bought, I own my property. I've built 2 properties. I've been through the construction process twice, had an investment property, sold it, made a good profit out of it.
Yeah.
Rebuilding now. Now I've restructured to renting my property out. Now I'm rent vesting. So I've got a lot of experience in that.
Absolutely.
And then obviously also structuring debt and how to align that debt because I'm doing it myself. I feel you are in that same position because you've got property you've just bought. I know because I helped with the policy to ensure that you got that. I was like, no, you can do it this way. Just get a letter. And it worked, right? It's just about, and that's the power of having the team because you were dealing with Adam and then I knew because I do so much self-employed that with that particular lender, if you're in this structure, you can just get a letter and that was easy. And then your accountant just had to play ball.
Yeah. So, that is, talking about going back to the point that we got a little off topic there, but about that you're talking about of like buying something that's not going to create equity.
Yeah.
To me, it starts with valuing correctly and not necessarily just being like, I think this suburb is going to go up, but being able to value a property in a suburb as at now and knowing that, this one represents actually really good value.
It's the underlying value that you can't actually see and don't realize till further. It's having the strategy, being clear on your strategy. Because, you touched that point going, I got the contract as valued at 650 because, that's the lowest valuation. It's the lowest risk for the bank.
Yeah.
Because I've got a contract saying 650.
Yeah.
It'd be interesting to see 6 months down the track. When did you buy that?
Almost 12 months ago.
Cool. It'd be interesting to see if we revalue it again, what it'll actually come in as.
I think, like if you go on Domain or something, it's somewhere in the 900s. The automatic valuation gives it, which is probably about right.
Yeah. And so if you're telling me in 12 months' time that's gone from 650 to 900.
Well, it's probably gone from 850 to 900.
Yeah.
It was never
true.
It was never 650.
But for all intents and purposes, you lent at 650.
Well, yes.
You lent at 650.
I came in at 650 because I knew that it was obviously worth a lot more. Anybody would have known it was worth a lot more. That was not just valuation. That was more about being able to negotiate a better deal because that was a complex property where we had 3 different properties in one line to purchase. And the sum of all parts was worth a lot more than what we paid for it because it was a bit of an odd asset to sell.
Yeah. Yeah. So that's, okay. That makes sense. And I guess so that, you've now just for your loan to value ratio, let's call that 80 at 650 will pretty much now be almost let's say it's 900. You'd probably be under like close to 60%,
something 60, like that.
65.
Yeah.
So you've actually created quite a bit of in the bank size. You've created that equity.
Yeah.
Which then, should you wish to do the next part or see more value in that property, potentially could. Or go buy another property.
Yeah.
So that's the value of being very strategic about it. And you were then also touched on a point around another pain point. If you're a time poor industry professional, you don't know property, you're not educated in valuations.
Yeah.
Are you the right person to do the negotiations? Could random person off the street have negotiated that deal? Be honest.
Oh, a particular deal?
Yeah.
No way. That was so difficult. Like I was stretched to the end because there was 3 different contracts, 3 different properties, all simultaneous settlement. I had to make sure that all 3 of the properties went through, all of the deals. 2 regular houses. One of them was a rundown, old, disused corner store with a uninhabitable unit at the top. And I had to find the right people for each of those properties. Yeah, it was so hard.
Yeah. But you got it in the end.
Yeah, we got there in the end.
Yeah. And I guess that's that power of understanding, like you looked at it and went, I think there's a deal here.
Yeah.
And just
I could actually smell it. Like I remember now when we first saw it and Jem in my office, who's actually on the podcast after me today, he showed me it and I saw it and I just knew that it would work because it was a really complex asset. I knew everybody would look at that and go, oh, that's too hard. I don't want to buy that. And then immediately I started getting excited about it because I knew that would happen. And I knew that if I could find the right people to buy each of those assets individually, we could all get a really good discount. And so we did. Yeah.
Winning.
Yeah.
So, we've obviously touched base on a couple of things, the strategy. What is the strategy, and should you use the buyer's agent? Like, is it appropriate if you don't have a strategy really to use a buyer's agent, or could you just close your eyes, throw a dart, hit, and hopefully you buy the right property or a decent asset?
Yeah.
Then we've talked about how not buying the right asset will impact the equity, and then it will actually stunt your growth because you won't be able to grow if you're not buying the right properties. And then we've talked about a little bit about negotiation. So you've obviously you've obviously helped quite a few clients lately. Can we just let's talk about a client that you've actually helped through all that process?
Sure.
Yeah, let's go. Because I know there's a couple.
Sure.
So
yeah. There's
So
a really good one. I love talking about the emerge clients.
Yeah.
And so one of the recent purchases, one of the most recent ones was emerge, and we bought one at Victoria Point, which is really funny because the last time we were on this podcast, we was talking about a different emerge client that we bought at Victoria Point, and it's a different property.
We haven't just resold this.
No, we haven't
guys.
just repackaged this as the only property I've purchased in the last 9 months. But that was a really interesting purchase, and
What was their goal? They came to you because
she wanted to buy a property under $900,000, and she didn't want to buy. Yeah, like she found that all the areas she was looking in, all the houses she was looking at, they were all over that. And pretty much admitted that she didn't really know what she was looking for and what would make a good property. And so she came to me and said, I can only spend up to $900,000. I think it was $900,000 including our fee. And so that, I don't know what that got her to, $880 or something like that. And said, I really want to buy, though, what should I buy? And I said, okay, under this price point, there's a particular strategy that I would use that involved a coming change to a planning scheme that not a lot of people knew about, which, I probably don't need to go into exact detail on that. It'll take too long. But we can buy for the value of a regular house. And she said, oh, right. And I explained that, once this planning change came through in the local planning scheme, that the value of the property would increase quite significantly, and explained that. It showed her the numbers, and she agreed with me very quickly of, that will definitely change the value of the property. And so I said, great. So we want to be buying a regular house, but not a good house, something that's cheap, cheerful, sturdy, but ugly. And we ended up buying this property that had a decent sized block of land that could benefit from this zoning change, the planning scheme change. And the house, it was solid, really solid.
Good foundation.
Really good foundations.
Yeah.
It was one of those 1980s A.V. Jennings houses.
Yeah.
But inside, this terrible wallpaper, this kitchen that looks like it was outdated in 1985 when it was built, kind of thing. But we figured out that you could actually just spend $25,000 on that and get a completely new house because the bones were all solid. The bones of that house were really, really good. And it was all this superficial stuff that made the house look ugly. And the client even, halfway through started to get cold feet on it because he's like, it's just, I don't know if I can do it. This house, the carpets are horrible. This wallpaper is the ugliest thing I've ever seen. And I was like, that's exactly why we're buying it. And so, we're going through the process now of doing that. And there's no doubt and we also bought it off market for what I think was a really good buy. And so we probably bought it to begin with, probably $20,000 under market value. But because it was the right sort of asset, by spending that $25,000, she's at least made $50,000. So I'd say, hand on heart, very easily that $850,000 purchase today is worth $920. And yes, she's had to pay 25, so 875 for 920, and that's without any market changes or anything like that.
Or
like
the planning scheme coming.
Yeah, exactly. That's just as it is today, and so that's equity that's being created just out of thin air.
And what was her sort of goal? Like, what's her long-term strategy?
Long-term strategy is just to hold.
Yeah, right.
Yeah.
And see the value once the thing comes up. You see the value in it.
But then I said to her that we wanted to get something where we can create some equity, get some value in it, and the planning scheme change as well, because a property will appreciate from its value, not its purchase price. And this is something I see as really misunderstood of someone going, oh, if I'm paying $850 for a property, then if it's going to go up in value at 7% a year every year, then that's how I can sort of figure out what the value be worth in those in the future. But now what we've done is we've spent $875,000 to purchase something that conservatively is worth $920. And so you could actually, instead of saying, well, I spent $875 on this, you go, I've got something that's $920. And so the growth will happen from $920 of the value, not the purchase price. And so that's what I aim for with all of the clients, is that's how we put them ahead, by getting instant equity and by having something that'll accelerate faster than the market. Because if you just bought the house at value, it will just appreciate at value. But if you've got 10% equity in the thing, then it'll appreciate 10% faster. And that's just assuming that it goes at the same rate as the market.
Yeah. And I think it's really hard. People go, oh, yeah, we conservatively will do this, and you try to work out the compounding value. It's like,
No,
you can't.
no, it's not like that's what's going to happen, but it's more just going, I guess, have a guess at what the value is going to improve over years.
It's interesting. What change, like, how do you see this value being impacted by the planning change? Like, what does that look like once that's in effect?
Once it's in effect, you will be able to build a new dwelling at the back, sort of like a granny flat, but instead of just building a granny flat, which you can now, you'd be able to essentially subdivide it off and sell it separately.
Yeah, like almost like a strata type thing. Yeah,
Exactly. That type of a thing. So,
Oh, and well, that makes it worth more than 920. Like
absolutely. That's definitely worth more than 920. I think if we look at it, like the numbers for us was, $850 plus the 25 gets you to $875. I think it was $425 would be the costs as at today to do the build. That gets us to, you're the numbers guy. What's that get us to? That gets us to
1.3.
1.3.
Yeah, close to 1.3.
No, I think it's 1.3. Yeah, 1.3 gets us to 1.3, and then at the end of that, you'll have two different assets, and between them, they're worth about 1.6, maybe a little bit more. So obviously that's good, but she's not developing straight away. She doesn't need to. No. That's not what this is about. This is not turning this client into a developer. No. It's about buying a smart asset that is going to appreciate well over time and has much more upside and benefit than a regular house.
It goes back to a strategy.
Yes,
because I want to hold it for a long term, and then what you're doing is the land's going up. It's the land that
absolutely.
It's not the house.
No, the land appreciates. Buildings depreciate, as they say. Yeah. Like, I last time I was on the podcast, I think I spoke about the statistic that I found from doing research of 30 years of sales in Brisbane, and I researched all of the property sales for residential property sales over 30 years, and we worked out that over 30 years, units and apartments, townhouses, appreciated by about 5.8%. Regular houses were 7.1%, and vacant land 10.5%. And so it's not saying go and buy vacant land as an investment, because that's a terrible investment, but buy something that has land, because land is what appreciates. And that's the proof of that the land is the thing that goes up. Yeah,
because by the time she's ready to complete that, she
may never complete it, and by the time she goes to sell it, it'll be something where everybody will know that you can do that on it and go, oh great, well we can build another house out the back and resell it. The value is just to do that. The property would increase so much more for sure.
Yeah, and if she was ever going to sell it, she'd obviously come to you first, hopefully, and go, hey, thinking about doing this, and then talk about, okay, well, if you're looking at doing this, is this the right
Well,
move?
either sell or build, and then if she builds, goes to you, and you help her to get the equity out of that property, because which assuming in the over 20 years or so, which is probably the hold period for her, created a huge amount of equity in it, and to borrow the money to do the build would be a no-brainer and be super easy.
Yeah.
But I guess it's a personal preference of whether that was a thing they wanted to do.
Yeah, and again, it goes back to their strategy, and again, you've hit the strategy, looked at how the equity is being built. You've sort of gone, okay, well, if this, because this is going to happen, this is going to happen, and you could do this. This is how it would look at building, and then obviously then you went and negotiated in on the deal because you saw a bit of underlying value.
Yeah, and ideally all three of them need to be ticked.
Yeah.
I don't think that purchase was particularly outrageously good because of the off-market deal. Like, it helped.
Yeah.
Like, getting it for 20 grand cheaper was good. I don't think that's ultimately the most important part of the deal, but it helped. And that essentially covers our fee.
Yeah.
Straight away. And so I think.
Well, the 20 grand allowed her to put 25 back in, and then obviously saving stamp duty, put it back in, upgrade the property.
Yeah.
Now it looks great. It's more into, we get a bit more rental income.
Yeah.
Hopefully for it.
Definitely.
Because you don't have crappy wallpaper.
Yes.
And you've got a new kitchen.
Yeah.
Someone want to live in it. It's got good bones, like you said. So you've probably boosted the rental yield up a little bit, and then also you've boosted the actual overall capital in the property as well. Capital growth's gone up, and now it just needs to do its thing.
Yeah,
we don't need to,
time will do it, because now they say that you make the money when you buy. Our client has made the money when she's bought.
Yeah,
and so that will remain a really good investment. Nothing will ever take that away from her.
And you got to ride the cycle out. 10 years usually is the
absolutely
round about right. And
100%.
We've got 8 years now. Olympics coming up. 7 years ish. Olympics coming up. Look, I mean, I don't know how that's going to affect the price, but it probably will do something.
Yeah.
Rates going down now, things like that. So there'll be lots of competition. I think it will drive prices up a little bit. But overall, it fits the strategy, meets her requirements. You got all three boxes ticked.
Yeah.
And she needed to use you because she had requirements for all three.
Oh yeah, and she's said many times, I never ever would have bought this without you.
Yeah.
I would have seen the wallpaper and turned around.
Yeah. It's too much.
Forgetting everything else of the underlying strategy that we were working on, and knowing whether it was a good value or not. Yeah. Just the wallpaper.
Way too much emotion. So no, look, we could probably crap on a little bit more, couldn't we, about all these different things? We've got heaps of clients, but mate, really want to say thanks for coming on. Really appreciate you taking the time out of your day. And also, here's the disclaimer: the information on this podcast is very general in nature, doesn't take into consideration any of your personal circumstances. If you want to know, if you want to go more in depth and have more personalized service around buying a property, or is that the right thing for you, speak to Chris, finance, speak to me. Mate, how does someone get a hold of you?
Look, probably the website's the best.
Yep.
lucidpi.com. And that's for property investment, not for private investigators.
Yeah,
is probably the best way to get in touch with us. And I assume that with the podcast here, you'll have the links and all that at the bottom.
Yeah, we'll have the links on there. You guys are on Instagram as well, aren't you? And
we do. We technically have an Instagram. The Instagram literally just has tiles that says, we don't do Instagram. We're too busy researching, finding good property deals. But yes, if you go onto that, you'll find us. I think we've got 22 followers, something so huge, booming Instagram channel there.
Man, you need some of the young ones to boost that channel up. But
yeah, you're probably right.
Yeah, but I mean, you're also on LinkedIn. I would highly recommend following you on LinkedIn. You're giving you're challenging the thinking, and I feel that there's a bit of lack in that.
No, I am quite active on LinkedIn. Yeah.
Jump on LinkedIn, Chris McNulty. Find him.
Thanks, Dion.
Not hard. And obviously you got myself. I am on Instagram. Stuff does get posted at Dion Finance Specialist on Instagram. LinkedIn, Dion Fernandez. And soon We'll have the Finance This Property That podcast, financethispropertythat.com.au website coming up where you can catch up on all the previous episodes. There'll be blogs and testimonials in there as well. So check that out when it comes out. But for now, we'll see you all on the next episode.